Okay, I thought we should do a little bit of a recap on Silvergate. Recall the prior video, video 128, I walked through this company, not as a recommendation to buy or sell or to traffic in, but just as a teaching tool for if you have a bear thesis on a company, how to participate and make money with a decline in a stock, and to do it in a way that's safer than outright shorting the stock, and instead by buying put options. So video 128 went through the mechanics, and we went through some different potential options to purchase. And again, not a recommendation, it's just a teaching tool. And I want to just take another look at this because this stock, it's just a gift that keeps on giving because it teaches kind of some foundational concepts for investing. Basically just to stay humble, because even when you're right about something, you can still be wrong on aspects of the thesis, and we'll talk about that in a minute. And it just sort of imposes sort of some humility and some risk control, and just the irony of the stock market is it just tortures you in all kinds of ways. So we'll just go through what happened and what happened with the specific options that we looked at. So first of all, the stock has dropped 10 points in less than a month. So it was at 25 when I did video 128. That was December 2nd. Here we are December 27th, and the stock is 15 something. And you can see that the short interest has also gone up. It's at more than double what it was before. I think it was 20% last time. So, you can see here when you get short interest in the 20, 30, 40% range, you start to get kind of a GameStop vibe where this stock could go up a lot under very little stimulus just because there could be a buy-in. And, who knows? But this is one of the risks of when you're short a stock, that it can have a squeeze and it can go up a lot for very little reason, actually, just because there's a high short interest. So, and then let's look at the options we had talked about. We looked at put options, obviously, and the months I was thinking about, and again, getting to irony, because my timing was wrong, I was looking out a much longer time horizon than was necessary. And so again, an ironic thing, right? I could have put up far less capital by buying much more short-term options. Because the stock dropped 10 points in a matter of weeks, I could have bought, say, options in January or February. I would have had to pay much less for the same strike than I would for a May option that we looked at, because time is money with options. And, that would have been, it would have produced a much higher return. Now, granted, you don't know that when you go in on an investment, right? So this is part of the humility. It could play out faster than you think, or ironically, had I decided to buy the shorter term options, probably then the thesis would have played out slower and I would have had my options expire worthless. So a lot of times it really helps when you go into making an investment or you want to take action on a thesis to just play out, okay, I'm going to be wrong. I don't know how. Let me think through different scenarios of wrongness. And this helps you kind of constrain your risks, kind of manage your bet size, keep things humble, and it's a good policy here. And this is just a great example of where, boy, I could have trafficked in much shorter term options, and the returns would have been much higher, right? But we'll look at the May options, and we looked at the 1250s, and we can see here they're now 330 ask, 330 bid, 350 ask. Now, and again, remember, whichever of these is the worst for you is the one that you are stuck with, right? So the way to remember bid versus ask is if you're buying, you pay the higher one, and if you're selling, you get the lower one, right? So when we first looked at the May 1250s, they were asked at 210, and now, of course, we could sell them at 330. And that's kind of interesting, right? That's about we'll call it a 60% return. 57% return, so not bad for a few weeks' work, right? We also looked at the May 25s, and they were asked 770 at the time, and now we're bid 1140. So you can see that the return on that one would have been about 48%, similar. And you can also look at the other month we were looking at, which again was way long term, much longer than necessary, and that was the January 2024. So 13 months out, we looked at the 1250 here, And here we have bid for 50, ask for 70. At the time, the ask was 330. So here we have the opportunity, if we wanted to sell it back, we could get 450 in proceeds on a 330 investment. 36%, 35 to 36% is the yield here. It was the gain here. So it's sort of interesting. You see the longer term options have a lower percentage gain, and the shorter term options have a higher percentage gain. And of course, if you had gone very short and had been lucky, you would have had an exceptional gain, right? So again, humility. You never know when a thesis is going to play out, and maybe it would have been better had I done something very short term, but at a low dollar amount, as well as some of these longer term puts as well. And then it would have had covered all my bases. And then the other thing to think about is, what do you do when you start to show, say, a 50 or a 55% return on an option? Well, I generally have just a sort of an overall rule that if I ever double my money in an options trade, I usually sell at least a third and often half of the position. So if you double your money in something and sell half the position, that means you've recouped all of your initial capital, so you can't lose any money. And then you sort of can let the rest sort of be a free roll. Just let it play out, and it doesn't really matter because you've recouped your initial capital. It is possible that the stock goes right back to 25, that these options expire worthless. And so this is one of the things that part of humility is to just make sure you don't lose money on the thing, but you still leave some on in case you're really right. And then you could still potentially make significantly more if the stock keeps going down. So that's a general rule I use. If I catch a double in an option, I'll sell a third for sure, and then sometimes sell half, and then let the rest ride. And that's, again, it's part of humility, right? It's sort of a risk management mechanism, because you never know what's going to happen with options. This stock could easily explode upward or go straight to zero. Who knows? So again, you want to think about, there's many, many ways I can be wrong, and I want to just try and cover as many of the bases as I can, and still make some money and still be right in some way. So this is the whole thing here. This Silvergate thing is really blowing up in front of our eyes, and it's kind of just a great teaching tool, a gift that keeps on giving. And as always, I hope these videos are helpful. Thanks for watching.